Hello, it's Chad Bergman with Movement Mortgage, and welcome back to one of our video series, which I brought in some great collaborators, amazing loan officers to talk about some changes for 2023 regarding Fannie and Freddie and their loan level price adjusters, LLPAs. Let's welcome Jordan Chomko and Aaron Brenner.
Hello.
How's it going?
Well, again, a lot of us don't know for conventional financing really what goes into interest rates sometimes. Why one would take a higher rate, one would take a lower rate. A lot of times we're just fed what that rate is and we don't have a backstory. But I think it's time that we talk about what goes into pricing, why people get different interest rates, and how we can maybe make improvements and some beneficial changes that are coming up. To kind of give us some backstory, I'd like to introduce Jordan to kind of talk about what LLPAs are.
Yeah. Thanks, Chad. Yeah. I think that defining what are LLPAs and how they operate within the mortgage space, especially conventional loans, is an important part of this. So I always relate it back to how are interest rates determined, right? So Fannie Mae is like the governing body of the mortgage industry. So much like in sports, they are the NFL. We as mortgage companies, we are the referees and consumers are the players. What happens is Fannie Mae sets out certain guidelines and rules associated with how a consumer's interest rate is determined. Those are what Chad is kind of referencing there, those LLPAs, loan level price adjustments. And these loan level price adjustments are things like credit scores, down payment, property type, property use. So it is kind of how we determine it. And one of the analogies that I like to use is think of it, and actually a coworker uses this analogy, is think of it like your driving record, right? LLPAs are your points for a speeding ticket, for a missed payment on a credit card is kind of what that is, right? Also, think about it, the different car that you buy. If you buy a sports car, you are going to have different adjustments to your insurance rates than that if you are buying a minivan. And to that extent, on the mortgage side of things, it is like buying an owner-occupied home versus a second home or an investment property. So those LLPAs is how it determines one's interest rate. And there are some positives and some negatives kind of going on with some of these LLPA changes from Fannie and Freddie. And one of the positive things, especially associated with first-time homebuyers, I'd love to kind of let Aaron kind of jump in here and talk about what Fannie is doing with those adjustments for first-time homebuyers.
Yeah, absolutely, Jordan. So as of about 6 weeks ago, it started in December, Fannie and Freddie rolled out an initiative to help first-time homebuyers who are under a certain income level. And I'm going to take Jordan's example with car insurance, auto insurance, where if you take the LLPAs that relate to credit scores, down payment, the type of property, say it's a condo or a multi-unit, say there's a subordinate lien, like you have, a second lien in place from as in the form of a HELOC or what have you. There's all these different adjustments that Jordan just described. However, there's a new initiative where if you're a first-time homebuyer, and the definition, by the way, for lending purposes of first-time homebuyer, no ownership in any property within the last 3 years. Okay, so you could have owned a home 5 years ago, 10 years ago, 30 years ago. As long as you haven't owned a home within the last 3 years, you're a first-time home buyer. And then the other part is income restricted. As long as the qualifying income that we, the lender, use on the application is under a certain level, all those LLPAs go away. All right. So any of the negative impacts of a so-so credit score or a low down payment or purchasing a condo, they all go away. And what this means for home buyers, first-time home buyers under a certain income limit, is better overall pricing. Now, how do we define those income limits? We want to show you there is a website that Fannie Mae publishes that takes a look at the area median income for every county in America. And so there's a chart that we go to this website, we input the address, and then it's going to show the area median income on there. Just to give you a little flair here, we're going to use the Denver area. So the city and county of Denver, along with Jefferson County, Douglas, Arapahoe. The area median income in these counties is roughly $117,000. Okay. This new Fannie and Freddie initiative for the first-time homebuyers, this is applicable for that $117,000 median income because that's 100% of it. We live in what's called a high cost area, right? And in layman's terms, it costs a lot to live in Denver and in the Metro Denver area. So Fannie Freddie actually allow us to go up to 120% of that number. In layman's terms, the number around here, $141,000 and change. So if you have one borrower, two borrowers, what have you, where the total qualifying income is at or under $141,000, and at least one person on the deal has not owned a home within the last 3 years, all the LLPAs go away, better pricing for customers. So this is something that we're really excited about. We've been able to bring in customers that are benefiting from this. I would say in general, the two groups of people that will benefit the most, people with 3% down. Historically, there's been a program for conventional loans with 3% down and no income restrictions, but the rate's higher, the pricing's higher. That is no longer the case if you're under that income restriction. And then condos, many realtors may know out there that there is a pricing hit if you're doing a conventional loan with a condo buyer that's putting down less than 25%. That hit is also gone for that subsegment of buyers. So again, we're pretty excited about it, and it just means saving money for people that are under a certain income level, haven't owned a home within the last 3 years.
I think you explained that extremely well, Aaron. I think we had a snapshot of that website. It's so big. This is a big change again for Fannie and Freddie, who are really driving the first-time home buyer. This is going to also allow people who would normally go, I think, FHA to come back to conventional financing. That's just a better overall program with a better interest rate, lower mortgage insurance, without the double layer of mortgage insurance that FHA has.
Right. Yep. So there, what you see there on the screen, that's the website from Fannie. And for realtors and buyers, don't feel like you have to memorize this or learn how to use it. Just ask your loan officer, and we're happy to pull it up for you. But you can see that little box at the bottom there, area median income. There's that 117,800 figure. And when you look there, it says 120% area median income. That's reflected by the fact that it's a high cost area. And if you were to put in any address in Denver, any address in Littleton, Highlands Ranch, Westminster, what have you, you're going to see that 141,360. The number is higher in Boulder. Okay. It's higher in Summit County, Eagle County, places like that. But then it's also going to fall back in areas like Colorado Springs, Pueblo, Greeley, and so forth. So again, trust your loan officer that when you have a certain address or even just a county, that the buyer is shopping in, let us take a look at it. We'll be able to know whether we can benefit from the waiver of those LLPAs.
Yeah. Well, again, to piggyback on the LLPAs, that was, again, a rollout that just happened a couple weeks ago here in January for first-time home buyers specifically. The other layer to this is some upcoming changes for all other home buyers using conventional financing that will take effect on May 1st. Lenders will likely implement this before May, but definitely loans delivered on or after May 1st will be impacted. We're going to talk about the reason why, and there's a snapshot of why Fannie and Freddie are making these changes overall. So last year, Fannie and Freddie made changes to the LLPAs for second home, high balance loans, cash out refinances. But they are really modifying this to implement additional changes that represent the next step in our efforts to increase and support borrowers historically underserved by the housing finance market while ensuring a level playing field for small and large lenders, fostering capital accumulation and achieving viable returns on capital. Very wordy, but what we pull out of this is that, again, it's really making adjustments to our current housing environment, our kind of higher interest rates. Again, what Fannie and Freddie are trying to push for homeownership and those that they serve. Some of the changes that are coming up on May 1st are going to impact different types of transactions. So before we had kind of everything lumped into maybe just general credit score brackets with down payment brackets, but it's going to be more diverse. It's going to be broken out between purchase and refinance and cash out transactions. We'll also have something that we've never seen before. We're going to have a small adjustment for borrowers who have a debt to income ratio over 40%. Again, that's your qualifying debt divided by income. And again, that may have a small effect on interest rate as well. We just want to communicate this, let people know that there's these changes. We have a heat map that actually will kind of pull up here that will show how those little changes have changed from the previous LLPAs. So again, if you got qualified 2 months ago, 6 months ago, you may want to revisit this with your loan officer. This could affect your qualifications. You may be pleasantly surprised how this can help you, navigate through this changing market.
And the key what we really want our real estate partners to know, this is not something to be scared of. It's not a reason for prospective home buyers to say, I don't want to buy a home right now, because it is important to keep in perspective. Like, yes, there's these adjustments in some ways, as you saw from the heat map. It's good in some ways, not so good in others. At the same time, rates have always been volatile. I mean, in fact, when you look at the numbers on there, and one thing to make very clear when you look at a chart for loan level pricing adjustments or LLPAs, it's in relation to pricing, okay? It's a percentage of the loan amount that affects pricing. It's not rates, okay? If you see a number 0.5%, doesn't mean the rate is 0.5% higher or lower. It means pricing is. So it's not quite as dramatic as people might think. I'm of the opinion that any adjustment that is 1/4 of 1% of the loan amount or less, whether it's good or bad, is immaterial. Folks should understand that pricing on rates typically changes by 1/8 or 1/4 on a daily basis, from day to day. So again, for someone to say, oh, well, the loan is 1/4 point more expensive, it could come back tomorrow, or it could have done that anyway just because rates change. So we want to keep it in perspective. The thing that I personally think is the takeaway is that more than ever before, buyers need to be in touch with their lender as far as the entire scope of their qualifying status and what their price is going to be looking like. I would say up until this point, if you lined up 10 reasonably similar buyers, reasonably similar credit, reasonably similar debt to income ratios, property they're buying, down payment, the rate and price is going to be somewhat similar, pretty close in the same ballpark. That's not going to be the case anymore starting in the spring here when these adjustments take place. And so, like I said, now buyers are going to be more creative with their lender. There's ways that we can try to get that DTI below 40%. Chad mentioned that's a change now. There's rescore opportunities where we can maneuver through credit scores to try to raise that. It didn't used to be as critical. Now it is. So, give a creative loan officer, an intelligent loan officer, a chance to work with these buyers and just try to save as much money as possible going forward.
Yeah. And the other thing too that I think is a positive takeaway out of all of this, when you look at both the first time home buyer component and what Fannie did to improve that for first time home buyers, as well as the LLPA adjustment, right? Yes, there are some negatives. Yes, there are some positives. They're really catering to a little bit more people who have a lesser down payment, maybe have had a blip on their credit score in the past, customers who in the past either would not be able to buy or would be forced to go FHA are going to have more opportunities here in the coming months. So I do think yes, there are some negative components that are coming out of this. There are also a lot of good components that, going out and talking to more first-time homebuyers, talking to people who maybe have thought they couldn't buy in the past, there will now be a few more chances for them to purchase. So I think those are all positives.
Yeah. Well, again, you guys have helped me break this down. It's a complex conversation. Again, it goes into the back end of our job. We want to bring it forward to kind of the conversation and some of the changes. I think, again, working with a knowledgeable loan officer is key, who can, again, break this down and let you know that there are opportunities and ways to take advantage of this market. So again, thank you, Aaron Brenner, Jordan Chomko. Again, please reach out to any of us with any questions and look forward to talking to you soon.
All right. Good talk, guys.
See ya.
Thank you.